Welcome to my presentation, The Strange Things Taxes Do in Retirement. My name is Neil Angel. I am a financial advisor in Greenville, South Carolina, and welcome aboard. Before we get started, I need to make a few mandatory disclosures. Keep in mind, I'm a financial advisor. I'm not a CPA, enrolled agent, or attorney, so the contents of this presentation are based on the things that I see today in my practice and not specific advice for your situation. I'm also not affiliated with the Social Security Administration or any other government agency. Having said that, there's a very practical aspect to this whole issue of taxes. Many of the decisions you will make will have some sort of tax implication, and whether or not you use a professional to anticipate those implications is another story. My goal for you is to help you to leave here with a better understanding of how taxes are different in retirement and avoids the very common tax pitfalls that many people face. Of course, I want to limit our discussion today on what is and not what you believe should be tax policy. Let's avoid political discussions and let's stick to those things that we can act upon knowing the rules of the game today. Does that sound fair? All right, well then, first of all, it's important that we understand the tax rules that we live under today. But it's equally important to identify any misconceptions that you may have about the way taxes are treated in retirement. And at the same time, realize that there are tools and strategies available to you as a middle-income retiree to be able to manage the tax bill that you may have. And again, let's avoid the political discussion and talk about those things that we can act upon today. Does this look like anyone you know? Well, if it does, you're not alone. So let's go. Let's do a quick case study to illustrate the idea of effective marginal rates and how they may impact John and Jane, our sample couple. Let's assume that John and Jane are married, they're both over age 65, and they're going to be filing jointly on their tax returns. They have a combined income from Social Security of just around $50,000 a year, but they also enjoy $15,000 a year in net long-term capital gains and another $25,000 a year that they take from their IRAs to supplement their income. We'll assume that they need around $60,000 a year in after-tax spendable income. But here's a scenario. Let's assume that they need to buy a new car. Should they pay in cash or should they finance? In theory, it's really pretty straightforward. As you go up in income, the rate you pay also goes up. This tax structure is specifically for ordinary income, which includes wages, most IRA withdrawals, pension income, and interest. This might be an easier way to visualize the tax brackets. We call it a tax map because it illustrates the rate at which each additional dollar of ordinary tax income would be taxed. In retirement, two of the most common sources of ordinary income are pension income and withdrawals from IRA accounts. Notice that from zero to the first $23,000, there's no tax, and that's due to the deductions and exemptions that we'll discuss in the next few slides. From about $23,000 to just under $40,000, income falls into the 10% bracket, and only income that falls in that range gets taxed at 10%. For the income that falls between $40,000 and $100,000, that is taxed at 15%. But let me ask you this. Suppose you're at the top of the 15% ordinary income tax bracket and you earned one more dollar so that you're now in the 25% bracket. What would be the impact on your total tax bill? Would it be A, a lot, significant increase, or would it be B, very little? Well, if you answered B, congratulations, you got it right. Only about half the population understands this concept. And it's one of the most common misunderstandings there is surrounding tax. Once you exceed a bracket, only the dollars that exceed the bracket are taxed at the new higher rate. Realistically, if that were all there was to our tax system, it would be relatively intuitive. But unfortunately, in retirement, we see several complicating factors. And each of the factors that I'll list in just a moment, as you'll see, create an environment where what you expect to pay may not be what you end up actually paying. We'll dig into this in the next section. And these factors include the required minimum distributions when you reach age 70, capital gains, Social Security benefits, Medicare premiums, any potential Roth conversions or large withdrawals from your IRA accounts, the 3.8% net investment tax that you pay as a result of Obamacare, the personal exemption phase out, any itemized deduction phase outs, and last but not least, any alternative minimum tax to which you may be subject. We've just hit on a very important concept, and that is the concept of marginal tax rates. Your marginal tax rate is the rate you paid on the last dollar of income. But this is where things begin to get a little strange. Welcome, my friends, to what I call the tax twilight zone.
You unlock this door with the key of imagination. Beyond it is another dimension. A dimension of sound. A dimension of sight. A dimension of mind. You're moving into a land of both shadow and substance, of things and ideas. You've just crossed over into the twilight zone.
And that, my friends, is the tax twilight zone. This is the real tax system that affects ordinary income for retirees. Do you remember John and Jane, the couple that we discussed early on? Well, the red portion of this map shows you what they should have been taxed based on their effective rates, their brackets at various levels of income. And if you remember, they should have enjoyed the first $23,000 of income with no tax. And then only after that, they would be taxed at 10%, 15%, and then 25% finally. But as a matter of fact, the gray area shows what they're actually taxed. And this is what we call the effective marginal rate. And it often surpasses the rates established in the tax code. Here's what their map looks like. You see, once they harvest a little over $10,000 in ordinary income, they begin to experience an 18.5% effective marginal tax rate on the next dollars withdrawn. And that's the point at which their ordinary income plus capital gains that they have drags enough Social Security into the calculation to begin making every additional dollar withdrawn from their IRAs taxed at 10%. And each additional dollar over that results in 85% of their Social Security income being taxed, creating an effective marginal rate of 18.5%. You can see this couple never really experiences the 10 and 15% brackets. They actually go from 18.5% to 27.75% to 55.5% effective marginal tax before dropping back down to a 30% effective marginal rate and back into the regular brackets. The complications we've just outlined should highlight one major point. Over time, when government has needed new tax revenues, the method has not been to change the rates or the brackets evenly across all taxpayers. Instead, it's been to introduce phase-outs of deductions or exemptions, or to begin including income that was previously not considered taxable, like Social Security benefits. The result is a tax system in which the most important number isn't necessarily the tax bracket you land in, but instead is what we call the effective marginal rate. In other words, how much of your last dollar did you actually lose to federal income tax? If you've ever filled out a paper tax form, you may remember seeing something like this. And basically this outlines what your tax bill will be at various levels of income. Notice the 15% bracket. That's the second line on the chart above. As you can see in the right-hand column, that taxpayer would pay $1,865 on the first $18,650 because the first amount was in the 10% bracket. On the additional dollar, up to an income of $75,900, they would be taxed at 15%. Qualified dividends and capital gains get their own brackets that are separate from ordinary income that we just reviewed in the previous slide. These brackets are lower primarily to meet public policy goals and encourage investment in the economy. There's still a marginal tax concept for capital gains and dividends, but the brackets are considerably different. So here's a question. At what rate are capital gains taxed? You guessed it. Although 15% is a rule of thumb, it does not hold true all of the time. So here again is a tax map. If you only had dividends and capital gains on your tax return, you would pay 0% until you have enough to fill the 15% ordinary income tax bracket. For taxpayers in the highest ordinary income bracket, the capital gains rate is 20%. This is the chart of the ordinary income and capital gains brackets together. Notice how someone in the 10 or 15% ordinary income brackets pays 0% on capital gains. This structure presents some really interesting opportunities for middle income taxpayers to recognize capital gains at a 0% rate when planning is done well. We'll now cover deductions, exemptions, and credits. These reduce your net federal tax bill, effectively making the first several $1,000s that you enjoy in your household tax-free. You can think of deductions as reductions to income for certain things that you spend money on. You can either track those things such as mortgage interest, investment interest, tax prep fees, and complete a Schedule A, or you can take the standard deduction, which is $6,350 per person in 2017. Of course, the standard deduction will be doubled under the new tax bill. But for retired taxpayers, there's simply not enough deductions to warrant itemizing on Schedule A, so the standard deduction becomes important. You might think of an exemption as an amount that is excluded from income simply by virtue of being alive. In 2017, the personal exemption is $4,050, which you generally get for each person claimed on your tax return as a dependent. Deductions and exemptions reduce your taxable income, indirectly reducing your tax bill. Credits, on the other hand, directly reduce your tax bill. Tax credits are specifically designed to incentivize behavior. Two of the most common tax credits are the health care tax credit and the earned income tax credit. A less common one, but one that may be accessed by some people who take part in a part-time job in retirement, is the saver's credit, which basically incentivizes lower income people to save into retirement accounts. Here's an example of a couple with $36,000 of gross income that is all ordinary income. At least $2,000 of the income must be in the form of wages. First, we reduce the income by the standard deduction for the married couple filing jointly, plus the additional deduction for those ages 65 and above. Then we reduce the income by two personal exemptions, and then we take off $2,000 for the contribution to a traditional IRA to come up with our taxable income of $10,700. Notice how the deductions and exemptions reduce the taxable income. Remember how our tax map showed no tax up to $23,300? That was the impact of deductions and exemptions. Thus far, our calculations have been pretty straightforward. But the first thing that complicates matters is the matter of required minimum distributions. Most clients have saved a pretty significant amount into their qualified accounts, that is their 401ks or 403bs or IRA accounts, over the years. And generally these contributions were made with pre-tax dollars on the front end, so all withdrawals come out as ordinary income. Once you reach age 70 and a half, you're forced to begin taking withdrawals. The process for calculating these withdrawals is relatively straightforward. Each year, you take the ending balance of the prior year and divide that by the factor representing the remaining life expectancy. And here's an example of the calculation. Notice that each year you age, your life expectancy goes down by less than 1 year. So the table runs all the way out to age 115, and even at 115 years of age, you only have to take out a little more than half the prior year's ending balance. No big deal, right? Well, here's the key. If you've done a good job of saving into your IRA account, your required minimum distributions plus your Social Security may be more than you actually need to sustain you in your life. And if that's the case, you may end up paying more taxes on the back end than you could be, as we'll show you in the next few slides. When you think of capital gains taxes, if you're like most people, you think of a 15% tax that's only recognized when you sell an asset that has appreciated in value. And it's not really something most retirees are concerned about. But what many people don't realize is that you can actually be imposed capital gains taxes on assets that you never sold, particularly if you own mutual funds. This is what we call a phantom gain. The best way to illustrate this is with an example. Let's say that you purchased a mutual fund in 2014, and And that fund held Apple stock going back all the way to 1985. And you held the fund itself all the way through 2015. But midway through 2015, the fund manager decides that Apple is no longer a good investment value, and so he decides to sell the entire position. Any gain that was recognized on the sale of that asset must be passed through to the mutual fund and the current shareholders, even if they didn't participate in any of the gain in the underlying stock. Bet you didn't know that, did you? One of the best examples of the counterintuitive way in which required minimum distributions interact with capital gains to create ordinary income is for the taxation of Social Security benefits. If your only income in retirement was Social Security income, you would pay no federal tax at all. But when you have other types of income, these can pull your Social Security benefits into a bracket at which up to 50 or even 85% of these are taxed. Many advisors will tell their high-income clients that 85% of their benefits will be considered taxable, meaning that the remaining 15% of those benefits are tax-free. For middle and upper middle income folks, however, that is often not the case, based partly on a formula that we call the provisional income calculation, which can impact your taxable income in a peculiar manner. Let's walk through this and show you how it works. Your provisional income is based on just half your Social Security benefits, but it also includes other types of taxable income, including ordinary income from distributions from your IRA and other qualified plan accounts, dividends and realized capital gains, as well as non-taxable interest on tax-free accounts like mini bonds. Bet you didn't know that, did you? Once we've calculated the provisional income, it's time to apply the thresholds. The key here is that only provisional income that falls over the threshold creates taxable Social Security. The best way to demonstrate how this works is by an example. We'll consider two examples of couples, both of whom enjoy an annual household income of $60,000. The first couple receives an annual benefit of just $20,000 in Social Security income and takes another $40,000 from their IRA accounts to make up the difference. We first need to determine what their provisional income is, and so in order to do that, as you recall, we take half of their Social Security benefits, or $10,000, we add to that the withdrawals from other accounts, in this case $40,000, to come up with a total of $50,000 in provisional income. Now we have to determine how much of that provisional income is subject to tax. In order to do that, you have to understand that there are two thresholds. The first of which for married couples is $32,000, and the second of which is $44,000. Any income from Social Security that exceeds $32,000 becomes subject to taxes at a rate of 50 cents on the dollar. And any income exceeding $44,000 becomes subject to taxes at a rate of 85 cents on the dollar. So in this example, as you can see, $18,000 in Social Security benefits fell into the first bracket. When we multiply that by 50%, we find that $9,000 of this Social Security is subject to tax. In the second category, we find that $6,000 in income multiplied by 85 cents on the dollar means that $5,100 would be subject to tax. When we add the two together, their total taxable Social Security benefits would be $14,100, or 71% of the total. Now let's consider the second couple. In this example, they enjoy a total income from Social Security of $40,000, or double what the first couple received. They're only required to take an additional $20,000 from their IRAs to make up the difference. And so again, if we apply the same formula, we find that their provisional income is just $40,000. Now, how much of their Social Security income would be subject to tax in this case? Well, if we follow the same formula, we find again that $8,000 would fall into the first threshold, and if we multiply that by 50%, we find that only $4,000 of the income in this threshold would be subject to tax. And because their total provisional income was under the second threshold, none of the income exceeded that, and so there were no additional dollars subject to tax. So in this example, the second couple would only find that $4,000 of their Social Security benefits would be taxed, or roughly 10% of their total Social Security benefits. So as you can see from the first couple, there's a big difference between the two. When we see this scenario played out on a tax return, the results become even more telling. In the first example, this couple took $40,000 from their IRA accounts. They enjoyed just $20,000 from their Social Security benefits, bringing them to a total of $60,000. But when you look at their taxable Social Security income, it totaled over $14,000, additional taxable income at $40,000, bringing their total taxable income to $54,000, minus standard deduction and personal exemptions of $23,000, so their net taxable income was just under $31,000. Their tax bill at the end of the day, just under $4,000. In the second couple, their total taxable Social Security income was just $4,000, additional taxable income of $20,000, bringing their total taxable to $24,000, minus standard deductions and personal exemptions, bringing their net taxable income to just $700 and their total tax bill to $70. So now we've covered the most common triggers that create both confusion and opportunity around tax and retirement. But we would be remiss if we didn't mention some additional areas that have the potential to impact your net income. And these include things that will primarily affect retirees in the higher income brackets. But they could also affect you in certain instances. As an example, if you were to convert some of the IRA money from a traditional IRA to a Roth account in any given year, or in the event that you made some large unusual purchase in a year, like the purchase of a vehicle with cash. Medicare is now means tested, and these thresholds include your full Social Security benefit rather than the provisional Social Security income calculation used to determine taxes on Social Security. If you fall over the threshold, you end up paying an extra Medicare Part B and Part D premium. In the scope of your total tax bill, it's probably not that much, but it's not insignificant either. After all, like Ben Franklin said, if you take care of your pennies, your dollars will take care of themselves. In 2017, Congress attempted to overturn the Affordable Care Act, otherwise known as Obamacare. As part of that legislation, individuals with an adjusted gross income over $200,000 or couples with adjusted gross income over $250,000 would be subject to an additional 3.8% tax on net investment income, including things like capital gains and dividends, interest and annuity payments, as well as passive business income and rental income. So that might be another consideration for those of you if you fall in that category. These are a couple of additional areas that we need to be aware of when it comes to calculating a tax bill. The first of which is the PEP, personal exemption phase out, and the second of which is piece limitation. And each of these will reduce your ability to declare either a personal exemption subject to a certain income threshold or to itemized deductions, again subject to a threshold. Now these thresholds go up each year over time, but it's likely the only way you'll see a personal exemption phase out would be if you were to do a Roth conversion in a given year or sell a big stock position or otherwise have an unusual spike in taxable income. The final distortion, again, only applies for people with higher incomes and lots of deductions. It's called the alternative minimum tax, and it's a flat tax that runs parallel to our normal tax system. It's estimated that fewer than 4 million taxpayers nationally will be subject to the AMT, so we won't go into a lot of detail here. Basically, your tax advisor or the IRS has a wizard to help you determine if you are subject to the IRS, and if so, how much. So let's revisit the tax map for a moment. Remember, as you increase ordinary income from the left to the right across the bottom, you can see the rate that should intuitively be applied to the next dollar earned. And here's the tax map for capital gains and dividends, at least in 2017. So let's do a quick case study to illustrate the idea of effective marginal rates. We have John and Jane, our illustrious couple. They're married and filing jointly and both over age 65. They have combined Social Security income of $50,000 as well as $15,000 of net long-term capital gains, and they take $25,000 in annual required minimum distributions. They assume that they'll need $60,000 in after-tax spendable income. Here's their tax map again. You can see that once they harvest a little over $10,000 in ordinary income, they begin to experience an 18.5% effective marginal tax rate. That's the point at which their ordinary income plus capital gains drags enough Social Security into the calculation to begin making additional dollar withdrawn from their IRA taxable at 10%. And each additional dollar over that drags another 85 cents of Social Security into the mix, creating an effective marginal rate of 18.5%. You can see this couple never really experiences the 10 or 15% brackets. They go from 18.5% to 27.75% and then 55.5% before dropping back down to 30% and back to the regular brackets eventually. If you're saying to yourself, whoa, wait a minute, that spike that occurred at the 15% bracket, how did that happen? Well, you're not alone. Intuitively, this couple in the 15% bracket for ordinary income would have expected that taking $1,000 in additional income would have created a tax bill of $150 or 15%. But here's what actually happened. The $1,000 withdrawal did get taxed at 15% as ordinary income, but then that caused $850 of Social Security benefits to be taxed. So that added $127.50 to the bill. In addition to that, that then caused a capital gains tax on income that would have come through at 0%, creating another $278 in tax liability. In short, on that $1,000 in additional income, the couple lost 55% of that money to federal income tax. How do you like that? You can see a very similar effect with capital gains. If the couple were choosing whether or not to sell a stock with $40,000 of gains this year, they would certainly want to know that on a portion of that sale, they would actually lose 40% to federal income tax. Maybe it makes sense to only sell a portion of that this year, maybe say $35,000 of gains to avoid the spike. The fact is that there are a lot of ways to control taxes and to plan in advance to create tax-efficient retirement income. Diversifying among different account types that have different tax treatments, using tax-deferred products where appropriate, blending withdrawals from different account types rather than simply harvesting in a sequential order, and paying close attention to which types of investments you hold in which account can make all the difference in tax efficiency of your retirement income. The bottom line is that these tax maps look completely different depending on your specific situation. If you'd like to know more, I would encourage you to schedule a time in the next couple of weeks, and we'll be glad to maybe look at your situation and see if there's some opportunities to save you a little money. I'll leave you with a little parting thought. This is one of my favorite tax-related quotes of all times, and the greatest name for a judge ever. Anyone may so arrange his affairs that his taxes shall be as low as possible. He's not bound to choose that pattern which will best pay the Treasury. There is not even a patriotic duty to increase one's taxes.